Good evening, everyone, and welcome to our live webinar. My name is Patrick Chang. I'm Chief Investment Officer. On my left here is Bunho, our Head of Fixed Income. And my further left here is Mabel, and she's our Head of Equities. You know, when I think about the third quarter that just happened, I only think of one thing, and that is volatility. And just a quick recap of what happened in Q3. People forget that we were actually going down very quickly in quarter three, and especially in the month of August, when volatility rose very, very sharply, right? We saw basically the yen unwinding, basically geopolitics on the rise. At the same time, we also saw people expecting the US economy to go into recession. You fast forward that to September or end of September, and you started to see markets starting to behave a little bit better, meaning to say that people were now starting to price in what we call a more soft landing in the US economy as well as in the global markets itself. Now, my job today is to basically give you some sense of where do we head going forward in light of what's happened. And I think you will share the same sentiment with me, that I think volatility is here to stay. And our job here is to give you advisory on what we expect in the quarter ahead of us. Without further ado, let me just start off by asking Bunho here about your expectations of the US economy. Now, like I said earlier on, we went through a turbulent Q3. People were expecting recession. Inflation was coming down. And then fast forward to today, people are now no longer expecting recession. So what really happened? What has changed the minds of investors out there?
So basically, it's not surprising that markets are actually very fickle in the short term because they are looking from monthly to monthly data. And I think if we look over the longer term, investors are actually advised to actually look at trends which actually plays out like lower inflation, slowing economic growth, and this will continue to drive the Fed to cut rates. And the Fed is actually acting because there is room for them to cut rates, and they need to do that to reduce recession risk.
So are you saying that the Fed came to the rescue of the economy sooner to actually adjust the expectation of what we call a recession?
I think in the sense that Fed is actually taking a very proactive step, trying to manage the soft landing scenario which they're trying to achieve. So basically, we are looking the economy slowing down to maybe about 1.6% in the US from 2.5% this year. So 1.6% is for next year. So that is the Fed's target, and they want to achieve that. In order to do that, they need to reduce the rates gradually, and that's what they are doing.
But if you think about the bond market itself, right, the market's always forward-looking. And you use the 10-year bond yield set as an example, right? Sure. It went from a high of about, 4.8% all the way down to 3.7% prior to the Fed rate cut.
Yeah.
Now, one could argue that a lot of this good news on rate cutting has been priced in.
Yep.
So why should people buy bonds still then?
Okay. Well, a few weeks back, bond yields has been adjusting higher. And I think that is actually a good opportunity for clients to buy in. The reason why the bond yields are adjusting higher is because there's recently concerns or resurgence of inflation coming up as the Middle East tension caused high oil prices.
Right.
And of course, 2 weeks ago, we have non-farm payroll numbers, which was a beat. And markets is now saying that, Fed don't need to cut that fast or that many times this year and next year.
But I think our in-house view is still about another 50 basis point cut this year and another 100 basis point next year, right?
That's right.
So if you think along those lines, basically, the other day, what you're saying is that when yields go up higher now, it's a very good opportunity to lock in.
Yeah.
But you can also argue that you can also try to time this and say, look, wait for the US president elections or wait for something before the year end. Why buy fixed income now?
Okay. I think now is a good time to buy because yields have moved up and we find it attractive. And if you consider the longer term trends of rate cuts, then that will play out in 2025 and yields will start to pay down later to 2025. So it's good to buy at a high yield and lock in and then ride through the rate cut cycle to get capital gains later.
For the audience out there, just to recap, our asset allocation call this quarter is to basically overweight fixed income, and hence the reason why I'm grilling Mr. Boon Ho here about fixed income a little bit more, because ultimately, the other day, we want to give you assurance of our views and our assumptions in terms of the fixed income asset class. Now, moving on to Mabel here. Now, obviously, when you think about soft landing, how does that play in your mind when it comes to equities? Given the fact that the US S&P 500 is not cheap, and there's a big divergence of valuations out there, right? You've got a market where it trades at 21 times PE, the NASDAQ trades at about 30 odd times PE, and then you've got the Malaysian market trading at 14 times PE, the Hang Seng trading at about 8 or 9 times PE. So why is there such a variance in your world of these valuations? And the second point is, do you agree with his view on soft landing?
Yeah, I think market expectations have definitely shifted. A couple of months back, people were talking about rising recession risk in the US. That has changed now because of the Fed being preemptive in their rate cuts. The expectation is that there'll be a soft landing next year instead. So in this environment, I think everyone's getting a bit more complacent, a bit more positive in terms of sentiment for the US market.
Right. So the key word is complacency, is it?
Yes.
In what sense? Is it a case where they're complacent about geopolitics? Are they complacent about the upcoming presidential elections? Are they complacent about earnings? What is the major factor that you think is the key complacent factor out there?
Well, actually, we think that in the next few weeks, there are two big uncertainties that are coming through in the US. First would be the third quarter earnings season that has just started. So companies are now reporting numbers. We'll be watching that closely to see what kind of guidance they give for next year. Second thing is, of course, the presidential elections. I think right now it's quite close. So we will have better clarity come November once we get past these two hurdles, and then we get a better sense of what the economic outlook is like, what policies are going to be like for next year, and that will help us shape our view for 2025.
Right. For the audience, we have been overweight on the ASEAN markets, neutral and China, and a little bit more caution on the US market, particularly on the US tech. So my question to Maple now is that, given the fact that ASEAN markets have done very well, I think if I recall in dollar terms, up a double digit, about 20%, right? In ringgit terms, maybe about 17%. And recently, we saw a resurgence in the Chinese equity market. Now, you can argue that why don't you just sell ASEAN out and buy China today when it's cheap? Is that a case that investors should be thinking about, or should be staying invested in ASEAN and still be cautious on China?
We would stay invested in ASEAN. We believe in the longer term story. But we wouldn't be too cautious on China either, because I think there are specific stimulus measures coming up that will help Chinese equities in the near term.
Right. But what has changed in China? I mean, so people talk about fiscal stimulus, people talk about stock market measures out there. What in your mind is the key message that investors out there need to think about when they think about China today?
Okay, so China has been in a bear market for past 3 to 5 years, right? So at this point, I think maybe rewind a little bit to mid-September. That was when the Chinese government came up with monetary easing. They cut interest rates. 2 days after that, there was a Politburo meeting that was unscheduled. So top government officials came together to discuss economic challenges. And in that meeting, they pledged to roll out fiscal stimulus and property support measures. Now, these two were...
But you've heard this before, right? So what's so different this time around?
We have had easing before, but the fiscal side has been missing. So I think the fiscal stimulus is what people are excited about.
Okay. So there's a lot of numbers being thrown out, and people are talking about a 2 trillion renminbi number and all that. Is 2 trillion enough, you think?
Right now, 2 trillion is the expected number.
Right.
So in order for the rally to sustain, we think fiscal stimulus needs to be in the range of 2 trillion or higher. If it falls short, you could see the rally being derailed.
So, just to recap, recently we wrote a note on Chinese equities. Effectively, we're telling customers out there to be staying invested and essentially being neutral on Chinese equities, right? And that view remains to be the case, right?
Yes, that's right.
Okay. So moving on to Malaysia. Okay. Right, I think we are now expecting the budget on Friday. In your mind, is there a top of the mind agenda that you think this government is going to try to address in the immediate term? What do you think is the top thing that the government will do in the upcoming budget?
What is most interesting to me would be the subsidy rationalization.
Okay.
We have not done this for many, many years. So that has been perpetually postponed by the previous government. So I think this government has shown a bit more, commitment to rationalize subsidy.
Right.
And I think that is actually positive for Malaysia because that will increase their fiscal prudence and also help with their credit rating. And I'm being positive if that will actually depends on how the actual execution played out, and the details will be actually more important to see what kind of details, how they implement it, how far they can carry on.
So you are expecting fuel subsidy rationalization equals to better budget management? Or
Definitely.
Which equates to?
I think that will actually be positive for Malaysia, especially from the currency point of view, and also for bond markets also. And of course, equity markets would also benefit from the positive.
Well, let me ask Mabel that you agree with that.
Yeah, definitely. I mean, if there are signs of the government managing their fiscal deficit better, that should be positive for ringgit. And then you couple that with a stronger Malaysian economy, that means you're going to get improved tax collections, maybe reduced subsidy burden. The other things that we want to watch out for in the budget are, of course, a reiteration of key infrastructure projects, maybe the commitment towards renewable energy, incentives to draw in more FDI into Malaysia.
Yes.
This would be positive if they come true.
And you think all of this, if that came about, will be the catalyst for the further re-rating on the Malaysian equity space?
Yes, but policy execution will be quite important as well, because a lot of this have been well telegraphed. So moving ahead, we will need to see actual projects take off in order to drive that earnings growth and further valuation re-rating.
So for clients out there, just a quick recap as well. We recently wrote a piece, a thought leadership piece on the comparison of Malaysia, and we call it the revival of the Malaysian tiger, and in comparing it against the journey that Indonesia went about a decade ago. And most importantly, in that message of the thought leadership piece was this whole article about, if you were to control budget deficits, the key there is also execution. If you execute it well, then you've got to get a major re-rating in equity as well as the fixed income, which what Bruno and Mabel talked about. So shifting gear a little bit, I forgot to ask you one question, Bruno, on fixed income again. And let's dial back a little bit, right?
Sure.
In a world where rate cuts are predominantly going to be happening in the next 12 to 18 months.
Yeah.
So stay invested in fixed income. But in what sector, in what area, in what currency would you suggest clients out there to invest in?
We favor the US dollar, Aussie dollar, and bonds, because we think the Fed cutting rates will allow more rooms for these central banks to actually cut rates to maintain competitiveness of their exports, and also the price stability from the currency point of view. Because I don't think anyone wants the dollar to depreciate too much versus their own currency. And the second point is, of course, we would think that a barbell strategy would help, some short tenor high yield bonds versus, and also coupled with some long tenor duration bonds that can capitalize on capital gains once the rate cut gets underway.
Is there any area that you're worried about in terms of credit out there?
I think the area of concern remains the property sector generally, because interest rates still remain high. But I think the Fed and the other central banks, by cutting rates, will reduce the risk of the property sector moving forward. So I think we are on improving trend. So I will be less worried about it as we move towards more rate cuts.
So I suppose the leading question from all this, if you are a investor out there who is naturally a fixed income person, sure, the first port of call when you think about investing in fixed income as well is in what currency fund, right?
Yeah.
So if you want to diversify away from ringgit, buy the dollar, you buy the GBP, you buy Aussie dollar. So
that's right.
So my question is very simple.
Yeah.
The ringgit has appreciated a lot this year by 78%.
Yeah.
Where do we go from here?
So the ringgit strength actually caught a lot of people by surprise. Yeah. But I think a lot of that is because of the US dollar weakness, because rate cuts are being priced in the paper. And dollar weakness has played out a lot in the first 3 months of the last quarter. So we think moving forward in fourth quarter, there'll be quite range bound with a bit of upside bias on the dollar side, because sometimes you have all this geopolitical tension, the Middle East hostilities actually will cause flight to safety and dollar, and that will support US dollar in the short term. But I think into 2025, we could see dollar remaining weak, and some currencies like Japanese yen and euro could actually outperform. The reason why we say Japanese yen particularly is because the BOJ is on the hawkish policy scenario, which is in very contrast and stands out against the dovish policy scenarios of other central banks in the world.
So in a nutshell, what you're saying is that in the short term, you do expect the dollar to appreciate a little bit, right? And
there could be episodes of strength because of flight to safety.
Going into 2025, you do see the dollar starting to weaken a little bit more.
Yeah,
right. So that will set itself up for ASEAN markets doing well, right? Because theoretically speaking, when you get a weaker dollar and stronger Asian currencies or emerging market currencies, you say, naturally that's what has played out in ASEAN, right?
Yeah.
Do you expect this trend to continue for ASEAN markets?
Yes. Actually, if you look at the chart, if you plot the KLCI index, for example, against the dollar ringgit, there's a very clear negative correlation, which means that whenever the ringgit strengthens, the KLCI tends to go up. And we think that will continue to play out as one of the factors supportive of Malaysian equities.
Right, okay. So we continue, as you heard now, we continue to like Malaysian equities on the back of this, and also the ASEAN markets. Now shifting gear to another alternative asset, and that's the asset class that we liked a lot since second quarter or second quarter of this year, and that was basically gold. Gold has appreciated by about close to 27%, if I'm not mistaken, year to date, and 17% in last quarter. That's a seismic shift in it's a class that doesn't give you yield and so forth, right? So where do we go from here for gold? Are we going to see $3,000 an ounce, or I've been hearing you guys talking about buy on dips, but it hasn't been a dip. You got gold, right? Yeah. So what do investors need to do about gold now?
I think after the strong run up, as you have said, 28% year to date, I think it's ripe for some correction in the near term. So we see gold pulling back maybe slightly, and we will still advise investors to actually hold and at least continue holding the gold, and of course buy on dips if they can below 2006. But of course the caveat is, provided these few factors that support gold prices continue to prevail. The first factor is of course dollar weakness. Second factor, if there's any geopolitical tension, then possibly gold will get uptrend big. So those two factors, as long as they are in place, I think gold prices will tend to be quite sticky on the upside. At least there are not so much downside in the sets.
Right. Yeah. So ladies and gentlemen, basically our view is to stay invested in gold, and possibly if there's any correction at below 2006, you should add into your position. Now, I think we still have about some time left, and I wanted to ask my colleagues here about the hot potato question.
Yeah.
We did not plan this. We did not plan. And so this question is about the upcoming US presidential election. Now, if I had to put a gun in your head today, which I wouldn't, but let's say I do that.
Okay.
And I tell you, it's a live and die situation.
Sure.
You have to commit to one party that is going to win.
Sure.
Who would that be? Is it going to be Democrats or Republicans, and why?
I hope Kamala Harris will win.
I want just one party. Okay?
Yeah, I hope Harris will win, because I think the policies that the previous president has actually put in place is actually quite good for US and also globally. So I think I would hope for that to be a status quo situation, rather than new president, the incoming President Trump, will be highly unpredictable. And I think if the policies are status quo, if Kamala Harris wins, then that actually is actually quite a good sweet spot for both US equities and US bonds.
And what about you, Mabel? Don't tell me you like Trump.
Since you put me on the spot, and since Woon Ho has already picked the Democrats, I'll go with Trump because I think that Trump tends to be more pro-equities, he's more pro-business, and a Trump presidency probably means lower corporate taxes, make America great again, so positive for US equities. However, it will probably have negative implications for China and Asia.
Right, okay. So for the record, the CIO office does not have an official view on who will win because we're not political analysts and neither we will want to be one. But, you can see how divided the views out there. We can see there in the polls itself, it's very, very equal chances of both parties winning. So which causes basically some form of expected volatility going into the elections in November. So I think we're probably at the end of our session. I just want to reiterate a few key points that the CIO office wants to allay to our customers or clients out there. Number one, in this environment in the fourth quarter where we do expect geopolitical tensions to continue, and the fact that we do expect that when the US market is as high as it is today, one has to be a bit more cautious on the US market, particularly on tech. Now, obviously, we do acknowledge that the market's starting to broaden out a little bit on the back of rate cuts, but we sense basically a bit of a caution out there. The second point is that on the fixed income front, we continue to be very, very bullish on that, largely because yields have backed up a little bit. We expect rate cuts to happen in 2025 and as well as the year end by 50 basis points by the year end and another 100 basis points or 125 basis points by 2025, right? And that will set itself out a sweet spot, as we call it, for the fixed income asset class. Last but not least, in the alternatives, our view is on gold itself, although it's appreciated a lot, we basically may want to actually hold on to it because largely speaking, if the dollar continues to weaken next year and basically if geopolitical risks continue in the background, I think gold will maybe hold on to it. So ladies and gentlemen, I hope you enjoyed our session, our first live webinar here. We do encourage you to go to our preferred website where you see the CIO views out there. We've written a lot about the markets out there, our top literature piece, our strategy pieces, and all the stuff that you want to do so that you can actually make some decisions for investments. Have a good meeting ahead. Happy investing, and we look forward to our 2025 outlook, hopefully by the end of December, if not early January. Thank you very much for your attention, and have a great evening.